Now, who the heck is Ian Tai? All right, so he's the founder of BursaKing.com online, which is give you the tools and materials that you need to do value investing, and he serves currently over a community of 4,700 retail investors. That is incredible. And he also is the founder of BursaKingWebinar.com. He is also a columnist at KCLoud.com, the fifth person, and values Invest Asia. And he himself is a dividend investor. He invests for dividend gains, and now his average portfolio yield is 6.5% per annum, which is a remarkable dividend return, in my opinion. Now, so could you tell me what is value? What is intrinsic value, and who should calculate this intrinsic value?
Okay, fantastic. First of all, it's my pleasure to be here. Thank you so much, Chun Sian, and as well as Person Malaysia for having me here. Now, to your question, actually, intrinsic value, right? You just treat it like this, all right? Just imagine yourself, if you are a property owner, all right? Let's say you have a house and you intend to sell your house, all right? So, but then you're not too sure whether what's the market value like for your house today. So therefore, you engage, let's say 2 or 3 valuers, all right, to come to your house to inspect the house and to see whether to actually check out what is the value of your house, all right. So 3 different valuers, so they come to your house, they actually look, see, check, inspect everything that is contained within the house, and then finally they come up with a valuation figure. So let's say, for example, if you have a house in, let's say, Subang Jaya, and it's a landed property, so 3 different valuers could actually give you 3 different kind of valuation figures. It could be, valuer A could say, your house is valued at 600,000. Valuer B would say it's 650. Valuer C is, selling it at valuer C. He's actually reckoning 700,000 as your valuation figure. So which of the 3 figures do you pick? Well, as a seller of the house, you will obviously try to sell it closer to 700,000.
Yeah.
And of course, if you happen to be on the other side of the party, which is the buyer, if you happen to be the buyer, you will obviously try to buy as low as possible, which is around 600 or 500,000. All right. So basically, this is the visual concept of intrinsic value. So therefore, to calculate intrinsic value here I would like you to visualize a stock, and then you are trying to value from a valuer what is the true value of the stock. So you're actually calculating that, and this is actually the purpose of today's webinar. And of course, when it comes to valuation, before we get into the maths and all the nitty-gritty details, so I'll just explain to you first and foremost who is this webinar for. Now, of course, the first one is actually about if you are a growth investor, all right, means to say you are an investor who is looking to actually invest in growth companies.
Capital gain.
Yeah, for it's not just merely capital gain. I will have to redefine what is growth investor. Okay. Growth investor means to say the companies that you invest, they grow in terms of asset base, client base, product ranges, assets. Their fundamentals are actually growing. Sales, profits, assets, cash flow, everything is growing. All right. It's not just speculating. It's not just, you speculate a stock and then the stock punctured by 20, 30 or 50%. Then you call that growth investing. No, it's a different category. We are very fundamental based. So this is actually for growth investors. Value investors, of course, because why do you calculate intrinsic value? Because you want to buy a good stock at discounted price. And this is actually for you if you are intending to own a stock and you have the mindset of holding it forever. It's for passive investors. Passive means to say, okay, active traders are people who buy and sell very frequently. Passive investors are people who do all the research, they buy and then they hold. All right, there's not much action going on after that. If let's say the stock actually drops in price and you believe that it is value for money, you will actually go in and buy the same stock, repeat purchases. All right, and of course the aim for this Intrinsic Value Masterclass is to help you to actually achieve long-term capital appreciation. So this is for you if your objectives for investing in the stock market is like that. Who is this not for? Number 1, speculators. Number 2, intraday traders. Number 3, swing traders. Number 4, short-term traders. Means to say short-term traders. Okay, let me define the period. Short-term means to say anything below 3 months. All right. So even medium-term, like 1 or 2 years, is actually still quite short-term. So just think of it as people who calculate intrinsic value is people like Warren Buffett, the kind of person who actually buys and holds like a stock or a pool of very, very good stocks and it's forever. All right. And of course, last but not least, this webinar is definitely not for gamblers lah.
Definitely. So if you are gamblers, you need to consider twice because stock market may not be for gamblers. I would want to suggest that you treat stock market like a place for you to acquire good, high quality company shares instead of taking it as a place to speculate and to gamble. Because chances are 90% of people who gamble in the stock market lose money. Yeah. So if you take it like you treat it as a place to buy and sell shares of company of good quality businesses, then I think your chances of succeed is much higher.
Correct.
All right. So can you tell us why do we need to calculate intrinsic value?
Okay, fantastic. So let's keep it simple first. Usually our webinars we will actually start with the simple, and after that we go with the far more technical stuff. So let's say, for example, today you read the newspaper or you go to Bursa Marketplace and then you found this stock that you like, let's say ABC Berhad. And of course, ABC Berhad is a fictitious company. So ABC Berhad is trading at 10 ringgit a share. So the question is always this: should I buy the share or should I hold onto the share if you are a shareholder? Or if you are a shareholder of this share, should I sell the shares, right? So what is the answer? So for those people who actually believe in intrinsic value, here's the thing. If, let's say, for example, the intrinsic value you calculated is, let's say, 15 ringgit, and now the stock price is 10, all right? So now you are thinking that, hey, the intrinsic value of the stock is worth 15 ringgit a share, but now it's trading 10, so you won't sell. In fact, you will buy more. On the other hand, if let's say you calculated the intrinsic value of the stock and you believe that, hey, it's actually the intrinsic value is at 8 ringgit a share. So the share price is trading at 10. Now you have the option whether to hold onto the stock for further gain, because everyone has this psychology that if it's above your intrinsic value, they hope that the stock price will go up to 11, 12 or 13 ringgit. Or alternatively, you sell the shares, all right, because you believe that it's overvalued. All right, so that is the main reason why we calculate intrinsic value. Okay,
all right. So would you be able to tell us what is intrinsic value? Okay,
so this one I actually copy and paste from
copy and paste.
Yes, of course. Hey, there's a saying, there's a saying from a successful guy now who says, all right, they say successes can be copied.
Okay.
All right. So any successful person, they actually model another successful person. So that means if you want to invest profitably, then of course you have to copy and model the people who are actually doing it, and they are very successful in it.
All right.
So it's actually I got this from Berkshire's Hathaway's annual report.
Okay.
So this is actually what it says.
How Warren Buffett defines.
Yes, how Warren defines.
Okay.
So let's do it. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. So as you can see, I have actually highlighted 3 key terms from these sentences: discounted value, cash, and remaining life. So let's go through these 3 in greater detail, shall we?
Sure.
All right. So let's start off with we can go to the next slide. Let's start off with cash. All right. So I'm going to start off with cash first. So why cash? And why Warren Buffett? If you actually study his portfolio, you'll find out that most of his stocks, right, they are cash cows, or they are companies with damn strong financial management, cash flow management is
like Coca-Cola.
Yeah, like Coca-Cola, billions in cash. Apple, billions in cash.
Okay.
All right, you won't find you won't actually find in the top 15 holdings of Warren Buffett, right? Or Berkshire Hathaway, companies that have negative cash flow. Companies that have, oh, no cash, but only overdraft only. They are not that kind of companies. You'll find that these companies always have cash flow. So why? Why cash flow? All right, there are basically 3 reasons. Okay, and I'm gonna just read it out to you. The first one is actually growth. All right, when you want to invest, when a company wants to invest, it is more flexible if the company has a lot of cash, right? Have cash can invest, no cash, how to invest? So how can the company invest? All right, which avenues? So it can actually expand organically. It means to say, I'm a manufacturer, I have 3 plants, now I have cash, so therefore I'm going to build myself another 2 more plants, and therefore I'm going to make more money from that 2 plants. Instead of 3 plants, now I have 5. Instead of 5, now I have 10. Expand organically. Or they can actually take the cash and they can, buy companies, all right, stakes of companies. So if let's say I'm gonna buy, let's say, another company, and I'm gonna control the company. I'm gonna buy like 100% of the company, or anything beyond 50%. That's subsidiaries. So that's one way of investment. Associates means to say companies that are where I'm gonna buy, let's say, 20% stake of the company. All right, 20 to 50% you will call it associates. Joint venture companies is like a 50-50 joint venture. It's like very commonly say, oh, I am property developer A, you are property developer B, you got cash, I got cash, so there is a land. Why don't we form a joint venture company and develop the land, buy the land and develop? So you only can do that when you have cash, when your financials are strong, then of course you can do that, right? There are so many avenues that you can actually invest to grow your income if you have cash, if the company has cash. Of course, there are many more. There are many more other forms of investment, like investment properties, like shopping malls and office buildings, and of course plantations, very common among Malaysian companies. Now, the key thing here is this: when you have cash, you can actually increase the sources of income without raising additional debt or equity. Equity means, oh, I want to invest, but I got no money. So what do? I go to the stock exchange and then I do a private placement, or I go and issue more shares through rights issue. When you have cash, you have the freedom. So most often than not, strong cash flow companies, right? All right, they generated or they delivered the best kind of capital growth. Cash leads to capital growth. That's tip number 1, right? I think it's worth it if you write it down. Cash flow always leads to capital growth.
Capital growth, it means share price growth.
Share price growth.
Okay, I see. Share appreciation.
Yeah.
Share price appreciation.
Correct. Now the second one is dividends. Now here's a contrasting thing between us and Warren Buffett. All right.
Okay.
Like in America, the tax structure is a bit different. The tax structure is such that when they receive dividends, they will get heavily taxed.
30% dividend withholding tax.
Exactly. So what happens is that Warren Buffett will always want to find companies which pays out lesser dividends, and instead hoping that the company is like a investment. How would I say? It's a good cash generating machine that not only knows how to generate cash from its business, but knows how to invest the cash that has been received by the businesses into more businesses. So it's like a vicious, it's like an upward cycle, and without paying a lot of dividends.
So they are constantly growing the asset. So
yes.
Like Berkshire Hathaway, constantly growing the asset.
Correct, without paying much taxes. But here in Malaysia, you receive dividend income, right? You don't get tax, right?
That's a good thing about investing in Malaysia and investing in Bursa Malaysia.
Yeah. So that's another option. No cash, how to pay you dividend? So go with cash flow. Third one is resilient. These days market uncertainties are are always constant. They are always here to stay. So which are the companies that are resilient, are going to stay, are going to weather the economic and financial crisis that we do not know when it will happen, sometime in the tomorrow, So the ones that have cash can tahan lah. The ones that have cash are resilient, they're stable because they can weather through these kind of storms. Imagine you have a company, you invest in a company that doesn't have cash. Then financial crisis.
Yeah.
Then how?
Then do rights issue, private placement, borrow money,
all kinds of stuff lah.
To raise the cash in the company. Yeah.
So these are the 3 reasons why they invest in cash.
Now, so that's why cash is the first part of the intrinsic value formula.
It's king.
Okay. So what is the second part?
Second part is, now we talk about cash, all right? Now we talk about discounted value. Why discounted value? Okay, now I think we can play around with this GoToWebinar software. I ask a question. What's the difference between receiving 10,000 ringgit today and receiving 10,000 ringgit in 12 months time? So if you have any comments, any feedbacks about it, you can actually type in. There's a chat box for that.
Yeah, in our chat box. Okay, please type in. Would you prefer to receive 10,000 today or 10,000 in 12 months time? And what is the difference?
What do you think is the
difference? Please type in the group, and then Ian will review to you.
Yeah. Let's see some interesting comments. Are there any?
Let me see. Okay. Some say they want it to be paid today. Some say B is lesser than A. Because there's an inflation, right? It's a keyword inflation, Ian.
Correct. What else do we find?
Yeah.
Okay, it's inflation. Better money in my pocket today. Correct. The 10,000 can be reinvested today, buying power. Okay, so basically most of you get the concept, all right? Of course, everyone wants to see money today, right? So this is, of course, it's actually quite obvious, right? Because it's inflation. The currency that we hold today, tomorrow it will be worth much lesser because because the money has been reduced in terms of its purchasing power, which is quite correct. All right. So the question is, what is the difference between 10,000 and 10,000 in 12 months time? So now it depends on one key thing. All right.
Discounted value.
Okay. What is your rate of return?
Rate of return.
Yes. Okay.
If your rate of return is high, then your compounded growth will be higher.
It's like this. Today, if let's say let's use FD as a benchmark, all right? 10,000 today, and let's say for example all you know is to put money into the FD, which gives you 3%. All right. So maybe you put in 9,600 plus or 9,700 into FD, and then 12 months later you will gain 3%, right? And eventually you get your 10,000, right? So that means to say the difference, if let's say your rate of return is 3%, which is FD, the difference between 10,000 today and 10,000 12 months later is actually about $300 lah. But if let's say your rate of return is higher, then of course the difference is greater.
Let's say it's 10%, then the opportunity cost is 10%, right?
Correct.
And because if you receive 10,000 today, probably by the 12 months later, you have compounded this 10,000 to become 11,000. Yeah. So the opportunity cost is the rate of return.
Correct. So let's go to my next slide and see.
All right. So we have covered cash. We have covered discounted value.
Yes.
And what is it about remaining life?
Okay. This is actually very interesting. Okay, because for Warren Buffett, like his definition, we are investing in a business where it churns out cash. Imagine a business that is working like a cash generating machine, that is generating cash every single day. All right, every single day. And how long is the remaining life? All right, for a long time. Okay,
but this is very subjective because
yeah, that's the third part, which is the assumption part. But of course, let me just explain a little bit about the concept of remaining life. Because a lot of people, when it comes to stock investment, they are either very short-sighted, very short-term oriented, means to say they buy and sell in, let's say, a few minutes or a few days or a few months. But the concept of remaining life is one that encourages people to look at the business as a entity, all right, that is sustainable, where your value is actually sustainable. It generates income and it will grow in value over the long term. So remaining life is always about forward-looking, not just forward-looking, but very, very long-term perspective. Now the question is this: how long is remaining life, right? Is it to eternity? Is it how do you estimate that? It's very difficult for us to actually estimate that.
Yeah.
All right. Because some businesses are actually quite evergreen. Like let's say, for example, today, Carlsberg.
Okay.
10 years ago, you drink Carlsberg. Today, you still drink Carlsberg. All right. Happy, you drink Carlsberg. Sad, also you drink Carlsberg. Anything happen, also you drink Carlsberg. Right. So Carlsberg, 10 years today, 10 years ago, 10 years forward, still there. Carlsberg. The taste may not change. If the taste change, maybe the stock price will change also.
Okay.
All right. So that is an example of remaining life. Technology companies, can they last for eternity, right? Can they last forever? Not really. It's like Nokia and BlueBerry and stuff like that. One time they are BlackBerry. sorry, BlackBerry, correct. BlackBerry.
Okay.
All right. One time they are very good. After that, things change, and then they are no longer very good.
Yeah.
Okay. So if you find evergreen businesses where people will constantly need to actually pay for it, all right, then you have a good estimate of. Then you have a much better bet on finding businesses which are evergreen, which have this remaining life kind of concept. Okay. Now, of course, with that said, we still need a assumption. We still need to make a benchmark assumption. Is it 10 years, 20 years, 50 years, 100 years, or eternity? Well, for me, I'm a bit conservative, so therefore I'm gonna just put 10 years lah. All right.
10 years. So it's a conservative. So are you able to tell us like Warren Buffett, how far ahead does he consider Coca-Cola remaining life? Like Coca-Cola to us, like I would see that maybe for next 20 years there will still be people consuming Coca-Cola, whether they are sugar tax or not. We will still consume Coca-Cola.
Yes.
So, like, would he also take it at 10 years, or take it at further longer period? Are you aware of that, or did he ever mention it in his annual report?
That one, not exactly. I haven't actually read that, but if he actually commented about it, maybe you can enlighten me about it.
Oh, yeah, I'm not sure. I don't know.
But for me, I think to say, here's the thing: when you actually measure a business intrinsic value for 10 years, it will be more conservative because the figure will be a little bit smaller as compared to 20 years or 50 years. All right, and in fact, it's number one, it's conservative. Number two, it's a much easier calculation because there's lesser calculation involved if you put it at 10 years. But to your question, I'm not too aware of that of Warren Buffett himself. But you can actually find patterns, meaning to say, when he buys Coca-Cola, how long ago did he buy Coca-Cola? Has he been a shareholder in that company for more than 10 years? That is the thing that actually will give us a clue whether on his investment philosophy. You see, he doesn't make billions by trading stocks and stuff like that, where his portfolio is always constantly changing when it comes to what shares he holds. But if let's say you read Berkshire Hathaway 2017 report, then you go back 2016, 15, 14, 13 to the last decade and to the previous and to the 90s and stuff like that. Of course, there will be people who read. All right, I don't. I just read I read a few years, and that's more or less a good gauge. But anyway, if you read so long, because it's available online, and you still find that, Warren Buffett holds Coca-Cola in the 90s or even in the 80s, and today he still owns. That shows his concept of remaining life, his attitude when it comes to investing.
Okay.
Okay.
So you have talked about three things. Number one is cash. Number two is discounted value. Number three is remaining life. So I'm sure that all of us will come online with understand intrinsic value definition a lot better now. So are you able to give us some demo to help us to understand how we can punch this figure, how we can calculate, so that we are aware of how you, as an expert, calculate the intrinsic value of a company?
I wouldn't say I'm an expert because
all right.
I wouldn't say, but I'm here to just share some mathematical formula where you can actually apply the formula and invest with greater certainty and confidence lah. All right, because it's better than just shooting in the dark, not knowing what you are actually getting into. Okay, so the live demonstration. Okay, the first one there are three things that I will actually do with you today. You will be participating with me. The first one is I'm going to answer what type of stocks are suitable to calculate intrinsic value. Okay, because do mind that intrinsic value, this formula is not for every stock listed under Bursa Malaysia. It cannot be applied to all 900 stocks. No way. It can only apply to certain stocks. The good ones only.
Okay.
Right.
So the bad ones
cannot
use.
Just cannot. Second, later you know why. Second, due diligence needed before calculating intrinsic value, because there are criteria that a stock needs to fulfill beforehand, before you can actually use the formula and apply it and calculate intrinsic value. So you got to do some due diligence, where I'm going to go through step by step with you on how to do that. And last but not least, of course, since this is a masterclass, we will have to do some maths work and we will calculate a stock's intrinsic value. Okay?
Let's do it.
So let's start with the first one. Okay. Basically, there are three criteria a stock needs to fulfill. All right, to best use intrinsic value. Okay, so I'm going to run this very quickly. It's only applicable for good stocks, like I said. So here are the three things. All right, just treat it as this: in the past, the present, and the future. Okay, the past, it must have a track record of growing profits, growing sales, growing profits, growing dividends, growing assets over the past 10 years. All right, so this is the past track record. Okay, so why 10 years? Why not 1 year? Why don't I just look at the latest annual report and just say, oh, this company very good?
Let me guess, because you can't estimate the growth rate.
Yes, that's one of the very crucial reasons. But of course, because investment, as you know, it's not just about making money. It's about being conservative. It's about, not taking too much risk. All right, or minimizing the amount of risk that you're going to take for investment to the minimum while maximizing your gains. All right, so here 10 years is a good track record because you want to minimize your risk. All right, it's more conservative, so take 10 years. Okay, now the present, of course, you will have to look at the present balance sheet to see whether the company has cash or not. All right, this is very important. Got cash, can invest. No cash, cannot invest. The third one is actually have a future growth plan. This one is very, very, very interesting. Just now, my friend here, Chun Sian, he said, you need to estimate the growth rate.
Yeah,
correct. So let's say, for example, if we calculated that the company's growth rate is 10%, now the next question is this: we are going to take that 10%, we are going to project it into the future. So the thing is this, to me, my question is this: on what basis, all right, on what foundations, on what grounds can I logically say that this company will continue its growth rate at 10% in the future? Because we can't predict future events. But in annual reports, all right, so that's why my favorite, for investors, right, my favorite website is actually Bursa Malaysia, because it contains tons of annual reports, financial results, quarterly reports, where I will always look at the chairman statements and the CEO statements and the MDA, which is Management Discussion and Analysis, where it contains the company's future growth plans. The good ones will always tell you what they're going to do. The bad ones, they will just say, cautiously optimistic. We do not know, but we are still optimistic, but we are very cautious. But we do not. But they won't actually tell you what they are gonna do with your money in the future.
There are many companies who never disclose about their future.
You just invest at your own risk, but then if you invest, then we welcome your money, but you won't know what you are going to do in the future, right?
Okay.
But the good ones, they will like to tell you, oh, this is what we are going to do in the future. Look, this is the plan that we are going to build. This is the property projects that we are going to develop over the next 3 to 5 years. Oh, this is this plantation, I tell you, wow, it's super lah. Then why do we invest in this plant? Okay, why do we invest in this estate? Well, they will tell you. So read, because it contains secrets to achieving capital gain in the stock market.
Yeah. Not many people like to read annual report, but if you do that, you're better than 97% of the people at the Wall Street. Because I remember George Soros says this. He said, if you read annual report, you're better than 97% of people in Wall Street because they don't read.
Yeah. So read lah. This is tip number 2. Reading is good. Okay. Don't cut short reading.
Because if you're going to invest in the company, you must really know where the company is heading to. Like treat yourself as a shareholder, like a partner to the business.
Yeah. Don't just say, oh, telecom drop. Oh, telecom drop. Then, oh, is it a good time to buy? But they never read annual report. Read like annual report.
Yeah.
Alright, you'll answer a lot of questions.
Yeah.
Okay, so with that, I'm going to just go briefly into what this stock is not for. Okay, so number 1, this formula you cannot apply if, let's say, the stock's profits decline or reduce. Okay, so if the profit is dropping, you cannot use this company. Inconsistent profits means there are up, downs, highs and lows when it comes to these companies. Then, of course, you cannot use the intrinsic value. Companies that lost money, poor financial standing, of course, you can't use that. Companies that actually generate money from short-term contracts. Because short-term contracts, companies, okay, if let's say you have a company that derives income from short-term contracts, maybe 1 or 2 years, like construction, construction companies. So what happens if, let's say, the contracts actually expire? Then the company needs to continue to replenish its order books in order to make sure that it sustains its profits. But let's say if it fails to do so, then your investment is like not so good because it fails to replenish its order book. So if you have that kind of company, then it's not so advisable to use this formula. Companies that have obsolete products, technology companies, of course you can't use that. And last but not least, if let's say you have a company that has a very good track record, has a growth plan, has all the beautiful signs of a good company, but yet it actually derives income from 3 customers, 3 Taiko customers only. These are the companies you better don't use intrinsic value lah. Because why? If let's say these 3 Taiko companies, one of them, they say, sorry, we are going to cancel your order. Then, very nice already lah. Then the company's financials will be jeopardized. What you want is a company that has thousands of clients, tens of thousands of clients. So that the stock is not over dependent on one major customer for his financial results. That's what I'm saying. So that's the criteria.
But let's say that I invest in this company that only have a few customers.
Only a few customers.
Yeah, the name of the company is Uchitech. So they have a few customers mainly in Europe, but the revenue is still growing. Over years the revenue is still growing and profit is still growing. Would you advise us to do that, or still cannot use intrinsic value?
You can, but here's the thing. I wouldn't say, because there's no guarantees that these customers will actually follow the stock, will give, let's say, Uchi, for example, like forever, maybe they have. So it depends on how long is their business relationship from one another, and how do you assess, how do you mitigate this risk is very important lah. Because whether or not you believe in the company, the risk is still there. All right, there's still a chance. There's still a 0.001% chance that the customer say, okay lah, sayonara, let's cut ties and not do business together. Okay.
Then we'll see severe fall in the revenue.
We may see severe fall in the revenue, but of course, some companies are like that. All right. Like for example, Globetronics had actually one of these times where a major customer say, oh, we are gonna reduce revenue and stuff like that. Then the share price just fall off the sky. I mean to say there are risks like that, but fortunately for Globetronics, I think their financials are okay. So therefore, that means
they also have a few mobile phone maker contracts.
Yes.
Does Apple have more?
I'm just saying if you are really that conservative, you go with ones that have multiple customers . Of course, you can always invest in things like Uchi or Globetronics, but make sure not every stock that you own is like that. Then that's another thing . Alright, that one you will cover it in your next class, right? Which is portfolio management stuff, right? Maybe you'll cover that. I do not know.
Okay,
but
anyway,
we got to do the
demo.
maths. Yeah,
okay, that makes,
because that's the juicy part of the presentation.
Just give me a minute.
Yes. Okay, so
okay.
Alright. So can they see the screen?
Let me see. Yeah, they can see the screen.
They can see do you see the the Google spreadsheet?
Yeah, maybe you want to zoom in a bit.
Alright, how do I do that? Is it here?
No, it's bookmark.
Sorry?
This is bookmark.
Where is bookmark?
You just the star you click is bookmark.
Okay.
Let me see.
Alright, so anyway, if you can see, I have actually listed down 7 stocks A, B, C, D, E, F, G. These are all real stocks listed on Bursa Malaysia. Okay, look at them. I have actually compiled their shareholders' earnings. That means their profits over the last 10 years. So from these 7 stocks, please let me know from A, B, C, D, E, F, G, which of the 7 stocks are the ones that can be used to calculate intrinsic value. So with that, let's see the response.
I see A.
Definitely A. Alright. So I'm sure everyone is on the same page. Okay. For those of you who have already answered A, congratulations. Do you mind if you got time? I'm still waiting for a few more response, but if you have time, make a guess. What company is that? ADFG.
F macam boleh, somebody say.
F macam boleh.
Yeah. Pun macam tak boleh from my point of view.
G. Nestle. No. Maybank. No, but close. Definitely not Maybank. G. Oil and gas. Someone say public bank.
Yeah, it's A, public bank, they ask.
Wow, fantastic. Congratulations, it is public bank. So I'm gonna just review the answer to you. Yes, the answer is A, public bank. Okay, some say what? D. Some say D. Okay, is there an answer called D? I'm gonna just review to you what company is this. Is Amway. Alright, so Amway did well. Alright, as you can see, the profits are actually going up. And then from 2013, it actually go down. So these are the companies that you cannot actually use to calculate intrinsic value, at least for this formula, alright, because it has declining profits. F macam boleh. Let's see. Kenapa macam boleh? Because it seems like it's a profitable company, right? But the thing here is this. From 2009 all the way to 2017, the profits didn't seem to grow much. Alright, the profits in fact stay flat. Okay, in fact it's actually of a different currency. it's actually SGX Limited. It's actually the stock exchange in Singapore. Maybe Bursa Malaysia's competitor lah. So this is how much they make on the
Look at 2008. They have more trading volume in 2008 during the financial crisis.
Before the financial crisis, they make a lot of money lah. Then after that, it tumbled. But after that, it stabilized lah.
Yeah.
But regardless of what, you cannot use this company because it's too flat. All right, it's a flat company. In fact, if let's say you want to invest for capital appreciation, you want the profits to grow. You can't have the profits stay flat, because if you go back and look at SGX share price through Google Finance, you see that the share price is also flat, no up, no down, because the profit is too flat.
But is it a cash cow business? But is it a dividend income stock?
Yes, you can get 3-4% from it, but 3-4%, that's all lah, because there's no growth, no nothing, isn't it?
There's one listener asking, is this net profit?
Net profit, correct.
Right. So these are all net profit.
Yes. G is actually not oil and gas. G is actually EcoWorld. All right. So EcoWorld is a decent company. Of course, it started to have all the property projects here. That's why it's profitable. Before this is another company. I forgot the name. Focal Ames.
Yes, Focal Ames Holding. Yeah.
That one is
was before 2013. 2013. Yeah.
There was a reverse takeover, right?
Yeah, the reverse takeover.
Then suddenly they become profitable.
It's a Johor developer, if I'm not mistaken.
It is a Johor developer. Yeah. Then this one cannot, because...
So we should take from 2014 onwards. So you cannot take the growth from 2008 until 2013.
Yes, because...
So in this case, we still need to do our own due diligence. That's the
that
word.
One? Yeah, correct.
And then to compare it only from 2014 until 2017. What a remarkable growth.
Yes, but you cannot actually just use this because you want to be conservative. You play safe, then play public bank. Right? So the rest of the 3 companies I'm going to just review to you. Asia.
Wow, somebody got it right, Heng Yuan. Okay, so one of the participants is guessing C is Heng Yuan. Okay, that
C is Heng Yuan, correct.
I think probably you studied this company profit over years.
Yes. And with that, we covered the first part, which is what type of stocks. Okay, make sure do this. All right, the profits. Okay, the profits must always go up. Now we are going to do some due diligence before we actually calculate intrinsic value. Okay, so all this data. So I'm a crazy fella lah. As you can see, only crazy people like me do this lah. So
yeah.
So I'm gonna just how do I go left? How do I go right?
Okay. Just give me a minute. Okay.
So
you know what? Let me just zoom out a bit.
Yeah, zoom out a bit lah.
Okay.
So
that you can see a more holistic picture. Okay, no, still need to zoom out a bit more.
A little bit more will be fine. Will be good lah. 100%. Oh,
is it okay?
Okay. Yeah lah, more than enough.
Okay.
Okay. So let's start now. Okay. Now I'm going to go to the due diligence part. So all this what you see now is actually a 10-year data. Everything that you need to know about public bank is in this Google spreadsheet. Okay.
Wow.
I compile stuff like operating revenue, shareholders earnings, EPS, what is loan portfolio like, how much dividends it pay, cash balances and stuff like that. You see, investors will always compile all kinds of data. All right. So operating revenue, if you look at this column, sales are growing, right? Therefore, profits are also growing. All right. Why sales is growing? Because the loans are actually growing. So it's very good. If you look at the cash balance, they have at 2017, 13 billion dollars in cash. So it definitely qualifies as a company that has tons of cash. Okay. If you look at the ROE, of course, it's above 10, so it's actually very good.
But it's diminishing over years.
And because I put the note here, there's a rights issue.
Because they are equity-based growth, I guess.
Yes.
Okay.
And that's because Malaysian banks, they want to be well capitalized. they are preparing for the Basel III capital requirements, where the capital buffer will actually go up. All right, what's that all about? Okay, because they want to prepare against financial crisis. So with that, they will actually want the banks to be well capitalized. So therefore, some banks like Hong Leong Bank, Hong Leong and Public Bank, they will actually do rights issue, raise funds from investors so that they have a much buffer, a bigger buffer to actually withstand against financial crisis, which is perfectly understandable. Okay, so the balance sheet is actually quite strong, and these are actually all available from Public Bank's annual report, which can be downloaded on Bursa Malaysia website. Segment data, this one I will actually skip because these are all nitty-gritty details all right? Net interest income, Islamic banking and stuff like that. Later I go through that all right, if I have time. This is the quarterly data, so sales is going up, profits are also going up, so not bad. All right, we'll just skip all this and go to intrinsic value. Okay, so this is actually my calculator. Okay, so I'm going to go through step one. Step one, you must always answer these two questions. All right, has it grown? Has profits grown? Is it consistent growth? If the
both must be yes.
Both must be yes. It cannot be one yes, one no. It has to be both yeses. All right. Tabulate these figures. These are copy and paste job You can actually copy and paste. I actually copy and paste from here. Now then from here, the first job we need to do is to actually calculate the company's growth rate, the profits growth rate. Okay. How do you do that? Now there's this website. We can actually, I'm gonna just type it to you Type right.
Can Investopedia, is it?
Yeah, you can put CAGR calculator and things will actually pop up I'm gonna help you click. So if you don't have my template, you can actually go to this website. I'm gonna share it with you how you do it. Okay, so now the calculator asks you to actually input three figures, right? So there is a beginning value, ending value, and number of periods. So I'm going to go through them very briefly. So beginning value. Hold on. Okay, beginning value is always this figure. So I can just copy and paste, right? Copy and paste. So that is beginning value. Don't think the calculator works with the commas. So
yeah, don't work with the commas.
So I'm gonna just delete the commas. End value is this. So copy and we paste. Let me try. Okay, delete the and number of periods. Okay, this is the more confusing part. So it's not 10 years, because this is starting value, which is the beginning value. This is after 1 year, after 2 years, after 3, after 4, after 5, after 6, after 7, after 8, after 9. So it's always 9 years. Okay, so we see whether the answer is 8.7. Okay, so let's put 9. Ta-da! So it's actually 8.7%. Okay. All right. So now we have actually calculated that the earnings growth rate is actually 8.7%. Okay. So of course, the next step is this. From there, you can actually look at the company's annual report to actually gauge whether or not the company can actually grow its profits by 8.7% per annum. Okay, let's assume it can because we don't have time to go through all the annual
because
stuff,
over
right?
10 years there is a growth rate. I think for the next 10 years
maybe can
should fluctuate around this figure.
Okay, let's assume we can all right. This one again, like I said, it's actually an estimate. No, this one is actually calculated based on actual figures, but to actually answer the question whether public bank can actually grow at a rate of 8.7% in the future, that one is subjective. That one, you figure it out whether can or cannot, okay? Now, moving on to step 3, now we have to project the company's earnings over the next 10 years, okay? Because we are very conservative, so we stick it to 10 years. And based on the 8.7%, all right, so I think the projected earnings are as follows. I think there's a mistake here. So let me just change this to 20. Is it C20? Okay. All right, so now we have the projected earnings. So 8.7% above this should be 8.7% above 5.47 billion should be 5.95 billion. 6, 7, 8, 12. Okay, so this is the amount of earnings that, based on 8.7%, public bank is going to earn over the next 10 years. But we need to discount it because, as we have discussed, money today is worth more than money tomorrow because of inflation. So now, therefore, we need to actually set a discount rate. Now, how do we decide what discount rate to choose, right? Again, this is very subjective. I put that 3% because I'm actually building a default calculator. All right, 3% is because I'm benchmarking it against FD in Malaysia. So I put that 3%. But of course, if you have a house, if you have a mortgage, and you say, hey, I don't need to do anything, I got extra cash, I can just put it back into my loan. All right, I pay off my loan and I save 4.5% interest because that's the BRL, the lending rate today. All right, then you can actually alter that and put that 4.5. Or like me, if let's say you can actually invest for 6 to 7% dividend yield, then you can actually put that 6 or 7%. So all these figures are actually up to you. All this pink color, all this reddish color, which I highlighted, is actually all manual input where you can alter it. You just don't try to alter this lah, all right? Unless like just like me, I make a mistake on that. If not, don't touch this. So once, let's say for example, if we put 3% as the discount rate, therefore we have the present value. That means the today's value of the projected earnings to be made in 2018. Okay, so that means to say these are the present value of the earnings over the next 10 years.
So if you have a higher discount rate, your present value will be lower.
I'm going to just put 6% to demo that. All right, you will have a lower present value.
Yeah.
Okay, so let's just stick it to 3. Okay, now let me just move to the right. I do not know what, and okay, before we go to the share price, you must actually look at the number of shares. So here I actually compile it, so it's actually here. I just copy this, paste it here. Now we can actually we have actually calculated the intrinsic value of public bank, which is about 19 ringgit. All right, how does it work? It's actually the summation. It's actually the sum of all this present value, and then you just divide it by this figure, and therefore you get 19.28. Sorry. Oh, before that, I think I might have confused a little bit the audience a little bit because I forgot to explain one concept here, which is this. Okay, just now let me recap what Warren Buffett said about intrinsic value. Okay, it is actually the discounted cash, right? But here I chill up a bit. I reduce earnings, cash or earnings, the discounted, which is 3%, value of the cash that can be extracted over the next 10 years, because 10 years is the remaining life. So this is actually the earnings for the next 10 years. If we add it up, it'll be 74.46 billion ringgit. All right. But this is the intrinsic value of public bank, but we need to split it into number of shares because unless you want to buy the entire company. If not, we are gonna just divide it by the number of shares, which is this, and therefore the intrinsic value is 19.28, which is 19 ringgit and 28 cents. Here I actually provided a link where I have actually I'm actually using Google lah, but you can actually go to Bursa Marketplace to actually find out the current stock price of what do you call public bank. So now the public bank one share is 24 ringgit and 60 cents, which is 24 ringgit and 60 cents. So in this case, you can see that the stock price is above the intrinsic value by some 27%. Now this gives you an option whether you should actually buy, whether you should buy, hold or sell public bank shares. So in this case, I believe, before I say that, why don't you just make it a guess? Will you buy public bank shares today?
Alright, so if you want to buy public bank share, please type in the box. What do you do? Would you buy, or would you hold, or would you sell in this case?
No, sell. Look, no, sell. Okay.
Many of you answered sell. Okay.
Buy more before price go higher. Stock market. Actually, the answer, it depends. It can be hold, it can be sell. All right. Because like public bank, you see, you're supposed to buy at a price where it's actually much lower, right? So the answer cannot be buy. But what if you have bought it at a lower price? Then maybe you want to hold on to it, which is perfectly okay. But if let's say you think that there are other better opportunities and you think that 24 ringgit and 60 cents is overvalued, then yeah, you can actually sell public bank shares based on this formula itself. Right? After all, we have a disclaimer. Okay, so this is actually the formula to intrinsic value. Of course, later I will be answering your questions. There will be a Q&A session. But with that, before we do that, let's go back to the slides. And
okay, would you mind to show, like, if it is discount rate is 6%, what will the intrinsic value be?
All right.
Okay.
6%.
All right. You see, if the discounted rate is higher, because different people use different assumptions. For example, if Ian used 3% and I, as the other investor, use 6%, and my intrinsic value is 16 ringgit that I calculated, and in that case, 16 ringgit versus the current share price 24 ringgit, right? It will give me a signal to sell.
Correct.
Yeah. So in other words, the discount rate could be very subjective. So sometimes we might say that intrinsic value, it will give Warren Buffett a set of financial statement and give his partner Charlie Munger another set of financial statement. Both of them will come up with different intrinsic value. So it's only an estimate. It may not be an exact intrinsic value.
Correct. Well said. Precise.
All right.
That is exactly what Warren Buffett
Maybe next time I can become a speaker in this topic.
Any of you also can become a speaker in this topic after that.
Okay.
So now,
today is your show.
Today I'm the one sharing. So yeah. So with that, actually Chun Sian has actually spoken about one of the limitations of using intrinsic value.
Oh, really? That's the next. Okay. I see.
That is my next point actually. Okay, but it's actually well said.
Done your part.
You save some time. All right. So I'm gonna just before that, let me just go back.
Okay.
Okay. So I'm gonna just wrap it up by sharing with you 5 limitations of using intrinsic value. One of it is intrinsic value is an estimate figure. That's number 1. Number 2, it doesn't consider dividend use. That means people who calculate intrinsic value, they did not actually factor in how much dividend use am I going to get. So therefore, you will have a mixture of portfolios where some stocks that you buy have good high dividend use, some are paying you lower dividend use. Okay. even though both have cash, both are cash cows, but one has high, one has low dividend yields. You have a mixture in terms of that. Second one is no considerations for short-term results. Okay. So let's say, for example, if a stock has been very good, but suddenly it was hit by one or two quarterly results, then the stock price temporarily over the short term may be affected. The third one is technical strength. Okay, so technical strength means to say some people means like my past webinar we have done SMA crossover method. So let's say for example you find an undervalued stock, the stock may become even more undervalued because the technical strength is not strong. So the stock price may actually drop in the future. Some stocks that seemingly to be overvalued, the stock price can actually go higher. All right, because the technical strength is much stronger. All right, so technical strength and intrinsic value, they do not actually collide. They do not go move in tandem. All right, but people who actually invest based on intrinsic value, they believe in one thing. They believe that if they buy the right company, the true value of the company should grow over the long term. The technical strength is just for you to, like as I mentioned in the last webinar, just to help you to find targets. All right, that's about it. Because it may move, stock price may move independently from the business fundamentals over the short term. But in the long run, it will move in tandem. Fourth one has been explained, as well said by Chun Sian. And the fifth one is, if a stock is undervalued, there's no guarantee that the stock price will eventually hit its intrinsic value. All right. So with that, I believe I have Kautim. I have actually do a live demo, explain everything and anything that you need to know about this topic, intrinsic value. So hopefully you guys have actually had fun. And with that, I'll pass back the control to my friend Chun Sian.
So if you have any question, please write it in the question and answer session. It's time to shoot our speaker with your earnest question. But while you are typing your questions, can we do something fun, which is can we launch a poll? Okay, now after learning this intrinsic value calculation method, do you feel you will apply it? All right, yes, maybe, or no. Okay, please give you 30 seconds to fill up this quick poll. At the same time, please write your question in the chat box.
Are there questions already? Maybe we can.
Yeah, there are a number of questions already, but while we're waiting for them to type more.
Oh, okay.
Okay.
While you're doing that, maybe we can just go to the spreadsheet. Maybe they ask questions and
now they're seeing the poll.
Oh, now they're seeing the poll lah. Just okay.
All right, so 60 of you have voted. So let me close the poll and let me share it. All right, so 52% of you say that you will use it. 44% say maybe. 4% say no. All right, so thanks for your honest feedback.
Thank you so much.
So let me go back to the screen. Wait.
Okay.
Hang on there. There is. Okay. Okay. Okay, we are back. So let me see if we have any questions. Okay, now before that,
yes,
may I ask my question first?
Okay.
So the question is, in your example, you are using earnings. Am I right?
Correct.
What is what is the usual metrics that people use? Like Warren Buffett, does he use earning to do the projection, or does it discount earning, or discount cash flow, or discount free cash flow?
Good question. Okay. The answer is, if you can do all three, by all means do all three. You will split your brain apart after that.
Oh, okay.
But anyway,
Brain damage.
you will have a brain damage after that. Okay, why for public bank I will use projected earnings? All right, good question. Because number one, I already know that it's actually a cash cow already. All right, that's number one. Number two, I use projected earnings because it's easier to use. All right, because it can actually give me a very good estimation of cash flow and stuff like that. It will give me a good estimation of the growth rate, sorry, not the cash flow. Because if you use the operating cash flow of banks, because banks, the cash flow is actually, it fluctuates based on a few things, It's not really entirely dependent on its fundamentals. It's like today I go to public bank, I have money, so I want to actually withdraw money. I can do so anytime, right? There's nothing to do with public bank, right? Or today you wire in money into public bank, so that's money in. All right. So that means because of this, right, there's a huge fluctuation when it comes to cash flow, cash inflow, cash outflow from the banks, and it's actually recorded under operating cash flow. All right, the changes in working capital. So because of these fluctuations, you cannot actually apply the cash flow from operations in public bank in that sense. Okay. Likewise, for other companies, it depends. It's a yes and no thing, because changes in working capital could include stuff like this. All right, your relationship with your suppliers or your relationship with your customers. All right, sometimes your customers pay you later. All right, it will affect your cash flow. So because of that, it's a bit harder for you to compute the intrinsic value of a stock if you factor in changes in a business working capital.
Okay.
You get a picture?
Yeah, but I guess not many people will use operation cash flow metric, but I think I heard that. And then in fact, when I first started calculating intrinsic value, I was using free cash flow.
Oh, free cash flow. I haven't answered that, right?
Yeah.
Then I just add a bit. Free cash flow is like, if the formula is like operating cash flow minus off the capex, which
Right.
is capital expenditure. So the question is, different company will have different kind of capex. So that one will. That's why I say your brain will.
So which metric does Warren Buffett use? Are you aware of that?
That one I'm not too aware of that. But if you read Buffettology, he will still use earnings.
He use earnings.
I believe so.
Buffettology, is it written by him?
No.
It's Mary Buffett, right?
Mary Buffett, yeah.
Oh, Mary Buffett use a lot of
earnings, yeah,
to calculate intrinsic value. All right.
to calculate anything.
To calculate anything. Okay. So okay, let me ask the questions on my screen now. So the first question is, does value investing work in Malaysia? When the share price for more than half of the listed companies in Bursa has declined significantly over the 10 years, I doubt that Malaysian company can purely depend on fundamental because they are not as stable as the United States stocks. So what do you think?
Let's say I don't think. Can I do a demonstration in that?
Please go ahead.
Oops. Okay, let me see. Note 1, right? So we got all kinds of animals here, all kinds of stocks from Public Bank, AirAsia, Heng Yuan, Amway, whatever. All right. So Public Bank, you see, the profits are actually growing, right? 10 years growing. So here's my mouse. Now let's look at the long-term stock price performance of Public Bank. So this is how it looks like. Okay. So what do you mean? So what do I mean here? 10 years profit growth, sustainable long-term appreciation. Okay, keep that in mind. Let's move on to AirAsia. Growth in profits, see, negative, positive, positive. And then after that, it has a drop in profits. And then after that, it grows back, right? Okay, now I'm going to just type in AirAsia. Just AirAsia. Okay. I'm going to just maximize. So you have up, so you see here, Asia, 2008 to 2010, profit go up. 2008 to 2010, it lags a bit lah, so profit go up. 2010 onwards, going
sideways?
No, 2010 to 2014, profits drop, right? And from there, stock price also drop. And then we have 2014 to 2017, profits go up, right? And then profits will go up. So that's Asia for you. So what do I mean here? Share price performance always follow profits, okay? Now, of course, we can move on to, let's say, Hang Yuan, okay? It doesn't have a very nice profit, and then until the recent years. So what happened? I'm gonna just type in Hang Yuan. Click Max. And there you go. It has declined when it comes to stock price, and then suddenly there's one punch like that. And of course, people who buy here, they kantoi lah. Because never ever chase a spike in stock prices. Not very healthy, all right, as an investor. Okay, let's look at Amway. It has growth in profits from 2009 to 2013, and then it drops in stock prices. Okay, this will be the last company that I'm gonna just demonstrate. You can do this all by yourself. It's very easy. Just all you need to do is compile the company's stock profits for the past 10 years and just compare it with the long-term stock price. And there you go, you see. From 2009 all the way up to 2013, the stock price actually go up. And then after that, stock profits actually drop, right? Then the stock price will drop. So over the long term, so how many stocks do you want me to demonstrate this kind of thing? The answer is quite clear cut. Profits and stock prices follow profits. You can actually do this.
Okay. Now, thank you so much for your answer to this question. And apparently, appears to me that there are a number of questions on the discount rate. Could you explain a bit how you arrive at 3%, and do you base it on the fixed deposit rate again?
Yes, you can base it on multiple things lah. You can base it on FD rates, all right? Because why? If you actually invest, all right, you could have actually put your money in the bank for 3%, no risk. So therefore, you can actually benchmark discount rate based on 3%. But of course, different people will have different rate of return, like I say. All right.
So if let's say my portfolio is performing at 16% or 15% a year, do I use 15%?
If you think that you can invest in a certain vehicle that produces 15%, all right, then you can actually, let's say for example, I'm going to just put 15.
If I put 15% of intrinsic value of Polybank is worth only 10 ringgit,
then that tells you that you should put your money in the 15% per annum kind of vehicle than public bank, because you are generating higher returns in that vehicle than putting it in public bank.
Okay, but isn't intrinsic value is about company value? It's not so much about my style. My rate of return is about a true worth of the company.
Yes. It's like, let me use the property as an analogy. Okay, last time if you are aware, all right, last time we don't have interest rates like 4-5%, right? Last time, if you remember, like decades ago, the interest rate could be 8 to 10%. You go to the bank, you ask for a mortgage, the mortgage will come out, the tenure of the loan is 20 years, and then your mortgage payment is like 8 point something percent. All right, and then your property is like very low when it comes to price, because your tenure, the loan tenure and the interest rate is very low. All right, the interest rate is very high at the time. But as time goes by, the credit is getting cheaper. 8% drop to 6, 6% drop to 5, 5 eventually drop to 4. So with cheaper credit, the value of the house actually balloon because people can now easily borrow and buy your property. So therefore your house balloon. All right. So when you use a discount, likewise, when you use a high discount rate, obviously the value of the stock will actually shrink because you're using a very high discount rate. It's like buying a house with a very high mortgage rate, very high interest rate. All right. So let's say, for example, it's like this lah. Okay. If you don't understand this, let me put this very simple. Today a house is, let's say, affordable housing is about, let's say, 300,000. Let's say lah. All right. And the mortgage is 4%. What if Bank Negara says, okay, no more 4%, 2% now. You can actually borrow. You can go to Maybank or CIMB Bank today and borrow at 2% for your house. What will happen to your? What will happen if you are a homeowner of that $300,000 property? It will inflate, right? Because now more people can actually borrow money to actually buy the house. But what if, let's say, Bank Negara says, no, we're going to increase our lending rate from 4% to 8% now. Suddenly nobody can buy a house because nobody can afford the mortgage. Then what happened to your house value? It will drop. So value and the discount rate, it's actually negatively correlated. Negatively related. High discount rate, low value. Low discount rate, high value. So it's very subjective. So that's my answer lah. How about the next question?
Now, how about can we use WACC as discount rate, which is the weighted average cost of capital?
Can. In fact, if you know how to do that, then you can calculate the terminal value of the stock. All right. So it depends on what you use as WACC. Then you actually go ahead with that. So the answer to that question is, yeah, you can use WACC as a discount rate. Correct.
Okay. So the next question is, what are the difference between intrinsic value and valuations such as PE, PCF, and other to value the company?
Okay. PE ratio. The good thing about this is I got this valuation data. Okay, so this is PE ratio. So the formula is as follows. Okay, you take the stock price, you divide it by its earnings per share, and there you go, PE ratio. Okay, so it's another metrics that I personally use to actually gauge whether a stock is overvalued or undervalued. So how do I do it is, the conventional way is you can either take the 5 years average, which is how much? 14.98. Okay, and then you compare it with the current PE ratio, and then from there you can see if the current PE ratio is lower than the 5-year average, then you can deem that as undervalued. If the current PE ratio is higher than the 5-year average, then you can actually consider that as overvalued. All right, you can either use a 5-year average or you can actually use a 10-year average. So it's actually to your liking. That's why I built this thing, because you can actually compare both, use the 5 years and the 10 years. Of course, for PCF, like I say, see, cash flow is this. Okay, there is a lot of changes in working capital, which is may not be the best way to actually reflect whether a company is doing well or not. Okay, so because like I said, like banks, people can deposit money and people can withdraw money at the same day or at any other time. All right, and it has nothing to do with the bank's ability to keep or the ability to manage cash flow, because it's your money, but money is flowing in and out of the bank every single day. All right, so let's say if a bank is actually fundamentally well, but it's just so happened that you withdraw the money, people withdraw is more than the money deposited, then you will have a lower operating cash flow. Are you going to be, because of that, value public bank at a much lower valuation? So that is something to actually ponder about, you see. If let's say a lousy bank, it just so happened that people deposit more money into the bank than more than people withdrawing money. So now you have a higher operating cash flow. Are you going to use that as a benchmark to value a lousy bank? Because it has nothing related to the fundamental business operation of the bank. So
Okay,
that is
understand.
So at the end of the day, the benchmark is you can use earnings. That's why I use earnings. But when it comes to cash flow, all right, you just need to make sure that the company has generated positive operating cash flow throughout the 10 years. All right, look, as long as the company has a lot of cash, it's more than good enough.
Okay, now the next question is, in Asia there are a lot of con men, okay, yeah, to manipulate financial report according to our or one of our listeners, manipulate report. So, would it considering that this financial report could be biased or manipulated to show a beautiful figure, can we say that it's very risky to use intrinsic value in that sense, and how reliable of this intrinsic value justify on this decision making?
Okay, so there are many ways to actually look at this issue. Okay, number one, corporate governance must be there. So first of all, thank God for Malaysia. All right, because Malaysia is, I believe, not that bad, not that severe. In fact, I invest a lot in Singapore, where corporate governance is even better. All right. Sorry to say that on the Besar Malaysia kind of webinar, but corporate governance is very important. Number one, all right, because if you have good corporate governance, your accounts are reliable. All right, but Malaysia is not bad, not that bad. The worst one, I think you can find it in mainland Chinese companies. That one is more tricky. All right, because but here's a trick that I actually was inspired or maybe learned from a friend of mine from the fifth person based in Singapore. So this guy, his name is Rusmin, so he taught me a few strategies. One of it is like this: if you have a company that is making money, okay, sales go up, profits go up, cash flow every year negative, every year cash outflow one, that's a red flag. There's no excuse for a company that has 10 years of sales and profit growth, but in that 10 years, 8 out of 10 years negative cash flow cannot be. But Chinese company can make it happen. And there are a few cases like that. All right, that's the first red flag. The second red flag is these kind of companies tend to do rights issue every now and then. Let me say every 2 or 3 years sure got one rights issue or private placement and all this kind of stuff. Then you know this company may not be legit already. The accounts may be a bit fakey. All right. So these are a few ways to actually track which are the con men and which are the legit businesses. But I suppose you can't. You can't actually say that to every single stock in Malaysia, all right? Because Malaysia is very rare to find con jobs lah, all right? Because still Malaysia is quite fair lah when it comes to this, all right? So you still can actually use the figures and park it on the template.
So the answer to that question is Malaysia is still fairly safe, okay?
Boleh lah.
To assume the integrity of the financial report that is being released by the companies.
You can say that, yes.
Yeah, but Chinese are more creative.
Chinese are very creative.
All right. So the next question is this intrinsic value calculation method suitable for all sectors in Bursa, or is only certain sector?
Like I said lah. Number one, not for every stock. Number two, 10 years profit growth must be there. Number three, if it's not there, please don't use the formula. The criteria is not based on sector. If not, I would have actually teach about sectors. The criteria here is profits.
Business performance.
Business performance, not biased to property developers, technologies, or plantation companies. It's not about sectors, it's about profits. At the end of the day, profits bring you the stock price performance.
Okay, the next question is, do we use this intrinsic value calculation? Let me answer that first. For me, I personally don't don't really bother to calculate intrinsic value because I used to do that when I first started out, but I noticed that my intrinsic value calculation is often off from the market performance, even though after a few years. So I would usually like to use PE as a valuation metric. But how about you?
As an investor, I believe you can use all angles. Okay, so like me, this is actually my working station lah. Because I have 10 years data, I have quarter data. See, I use everything. I use PE, I use dividend yield, actually this is PB ratio lah. So I use PB, I use dividend yield, I use PE, and then I got this intrinsic value calculator. I use 4. In fact, I got another one which is capital gain. This one is again from the Warren Buffett book that I actually designed this calculator where I can actually even calculate or estimate what is my capital gain to be expected if I invest in public bank. So I use all angles. I use a lot of metrics to actually assess public bank or any stock before I actually invest.
Okay. So would you think that a quarterly quarterly earnings is a better gauge? There's another question.
Like I said, I'm actually more all-rounder. This is 10 year, right? This is 10 year, right? So this is quarter. Now you see, quarter you have to use this. I have public banks quarter results since quarter 1 2012, and then I have if you can, let's see how many counts I have. 27 divided by 4 is nearly 7 years of quarterly data. What does it show me? It shows me that revenue has been consistently growing. If I move to the right, profits are also consistently growing. Therefore, sorry about that. Okay, let's go to public bank. And therefore, stock price has been growing. So if you want to use quarter data, you can do so, but tabulate it like me, and you will get a lot of revelation if you're hardworking. The thing is that if you just choose to, I only go with 1 quarter, then you won't see anything.
So the next question is, how do you get 10-year data?
Bursa Malaysia.
But then Bursa Marketplace only show 5 years. That's the next question.
Okay. Then in that case, let me just show you how to use my favorite website, Bursa Malaysia. Okay, so people are seeing this, right?
Yes, they are seeing your screen.
Okay, so public. Okay, so go to securities. I go to securities. Actually, there are faster ways, but in my computer, I already pretty much automated everything. So never mind. I'm trying to go to not shares. How to go already? That's fine. Sometimes you need to use your own laptop, right? But anyway, I'm just gonna. I need to go to the company announcement part.
Company announcement, is it? Okay, let me find for you. Okay. You tell me what you want to do.
Company announcement. Yes, listed there. Company announcement.
Okay.
Okay, if you want annual report, it's here. Then click public bank. Okay. Then everything is available to you. See, you have all the 10-20 years data and 10-20 years annual report.
But I guess I think they're asking how do I get the number without getting all the 10 annual report?
This one
Is there a faster way?
This one I only do it with because bersaking.com.my people pay me, and then they text me, and then I do lah. But then I don't think there's any other way lah.
So
it's all paid service already lah. But then sorry to say,
the point is, if you want to get this data, you got to subscribe to bersaking.com.my. Okay.
But what I'm saying is that let's say you want to save time, then you pay. But then if you want to save money, then this is the avenue lah. I do this. It's free what, you know? It's Bahasa Malaysia, free website what.
Yeah.
Hardworking a bit lah.
Yeah. All right. So you want to save money, you have to be more hardworking.
Yes.
Okay. All right. So we have actually come to the end of our webinar. So today we have a great interest and we have great participation. So, all right. So let's go back to our slide. Okay. What I want to share with you is in our next webinar, you learned, which is our last webinar of this year, you learn understand the essence of portfolio management. It is on the 4th of December. It's a Tuesday, first Tuesday of December, 8:30 to 10 o'clock. And then this is the registration link. I will put the link in the chat box shortly. And please join us in our webinar to learn how you can construct a better portfolio for yourself. And today I want to thank Ian for joining our webinar to share with us how we calculate intrinsic value. I'm sure you learned from it, right? If you learned from this webinar, please type yes in the question box, in the chat box. All right. If you learned from it, please type yes in this question box. And thank you so much for your time to share with us how you can calculate it.
Yeah. One more thing, just to add
yes,
on.
one more thing.
Okay. I know. Just now, let me show you a bonus lah. All of you a bonus.
There is a bonus. So there's a gift for subscribers. Okay.
You know the template, the public bank template, right?
Yeah.
So if you want it, that's my email, iantai888@gmail.com. Just say I want the template, and I will just be happy to share with you the template. That's the bonus lah.
That is the bonus. Now, how many of you find value in the Excel sheet that Ian used just now? All right. If you find value in the Ian Excel sheet, please write to Ian at iantai888@gmail.com. He will give you the access of the template. All right. Please email him.
Yes.
All right. So just give me. So this is for our faithful audience who actually follow our webinar series. Okay, wait, oops, let me copy this. How do I do that? Okay, so for those of you who want to join our next session, here is the link. So please go to the chat box and click the link to join to register for our next session. As usual, it's very limited, so please register early. Okay, so we have tons of more value we want to share with you in this session. So please go to our chat box to click the link to share to register for our next webinar. With that, thank you so much for being a wonderful audience, for tuning in, for asking many of your intelligent questions. So we look forward to empowering you in the next Bursa Malaysia webinar. All right, and have a pleasant rest of the day. Bye bye.
Bye.